In this video, I'm going to be showing you how one simple tool, the Trendline tool, will be able to very potentially revolutionize your trading and investing. And furthermore, go much deeper into the concept of higher timeframes and how the combination of a simple trend line could not only help you predict the future, and the key being in the name, it's a trend identification tool. I'm not only going to be showing you how you can predict the future both to the downside and upside with this simple tool combined with higher timeframes, but also how it can help you on a slightly shorter time frame basis understand key potential turning points in the market alongside how to use them in the correct way. Now, trend lines are heavily mocked by many people because you think, well, it's just a line. How could that be beneficial to my trading? And that's where a lot of traders go wrong. They think the simplistic tools are really a negative, whereas complexities and all of these cool names and loads of indicators is actually what makes you successful. From my personal experience over the years, I have lost more than I've won and suffered the worst of losses by trying to make trading more complex than it actually needs to be. And the key to my success over the past few years, especially, which has significantly rocketed, has been stripping the slate clean and really narrowing down on the basics. I only use two real tools myself, and this is going to be the key behind this video. I use trend lines and I use Fibonacci's. That is combined with many other things, even down to intuition, to make a concrete decision within the markets. But at the core of it all, I'm only really using two tools, a trend line and a Fibonacci. Now, when we move into the idea of higher timeframes, everyone has a different perception of higher timeframes. For me, personally, the weekly time frame, the monthly time frame, and even higher than that in many circumstances is the most effective form of higher time frame to use specifically in cryptocurrencies. And we're going to be breaking down in this video how the combination of both will revolutionize your trading. I'm not even joking. It's so simple, it almost sounds stupid. You almost look at it and go, well, it's too easy. It's too good to be true. But that is the beauty of the simplicity in trading. We actually overlook the simple stuff. We make it so hard on ourselves by trying to make everything complex and intelligent and just try to seem more intelligent than we actually are. But the truth is, the simplicity of trend lines and higher timeframes allows you to really expand your scope and acquire, the key word here, a bird's eye view over the market, which is always crucial when trading something like cryptos, which move far larger than any other asset class we have out there. So I have no doubt that once you've watched this video, it will not only open your mind, but it will also directly correlate with anything you currently do. And what you will learn after this video also is that a singular trend line can assist you with your overall analysis using your own strategy and formula. That's the beauty of it. Trend lines are mocked not just because they're simple, but also because everyone uses them, and most people do not find success from using trend lines, and that's the key. Trading is manipulated, and what is frequently used by most retail traders will not work if used in the same way that everyone else uses them. But if you use them intelligently and understand what they can actually give you in terms of data, you will see significant growth in your trading. So let's jump into the charts and start breaking this down. So we're going to start off using predominantly the BTC USD chart for this video. We may look at some other pairs, but the most important thing to do to even start this video off is use a daily time frame to help begin aiding you in understanding the importance of higher time frames. Now, a common misconception, just to mention from the offset, is that people think your trading time frame is dependent on the time frame you view the market, and that's not necessarily true. In fact, the daily for me is the perfect all-rounder between a short-term time frame and a higher time frame. And you can actually execute even intraday trades based off a daily time frame. And it essentially stems down into some form of rainbow and pattern index, or a rabbit hole, so to speak, where the patterns progressively go down in time frames. Now, for most people, a daily time frame is an incredibly high time frame, and often far too much to be watching when you're trying to take intraday trades, which we know a lot of crypto traders with leverage do, specifically on lower time frames. They don't always look for large swing trades. Now, whilst the daily time frame is very effective, I'm going to show you how it's effective, because if you think about intraday moves, You're looking for an intraday move or intraday move, which is either throughout the duration of that entire day or throughout the course of several days. Now, wherever the case is, if you are looking for short term trades that take place in the span of ideally 24 hours, the daily time frame is one of the best starting points. If you're looking for a trade that is going to be around 24 hours or within the span of a day to several days, the daily is still fantastic for that. And that's when you can increase to the weekly time frame. But for long term investing and trading collectively, the daily is simply not enough. Now, whilst it looks like you have a lot of price action on your chart, there is a real general rule of thumb here. And that is the less of the overall chart you can see, the less clarity you will have overall. Because, of course, the price action is relevant to this present moment, but the price is always reacting to historical levels that can stem back many weeks, many months, and many years. So, what you see here, whilst it may be more than what you're used to looking at, is a very limited perception of what is happening overall. And as an example of that, we will highlight everything we can see on this chart from top to bottom in this overall range, and then begin to zoom out to what has taken place throughout the entirety of Bitcoin's history. And you can now see you're actually viewing a very limited window, especially if you go back to that's not really relevant, but from 2017 onwards, you're actually gauging a very small percentage of the overall chart. And in terms of trying to predict what may happen in the future, what may happen in the medium term, the short term, and the long term, this isn't necessarily enough because a lot of what you see on the outside remainder over here can actually play a fundamental role in helping you predict what takes place in the current region. So the past is the best way to predict the present and the future. And I'm going to show you how. Now, first of all, before we even do that, we need to look at what most traders do. And that is mostly sticking down in crypto to a 4 hour, a 1 hour, or most frequently from what I've seen, a 1 hour time frame and less. Now, if we apply the same concept here and look at everything that's expanded within the chart, and for most people, it's more the current price action. If you just look with as much clarity as possible, also worth mentioning, you need to have as much of these candles visible as possible. And what I mean by that is if you have to scrunch it up to the point where it's no longer visible and the candlesticks essentially disappear, you are too zoomed out. You need less candles on your chart. And the next rule of thumb I'm going to show you before we delve into higher timeframes is the key rule of thumb here. The less candles you have on your chart that enable you to see the entire picture, the easier it will be. The more candlesticks you add to the equation, the more complex the analysis becomes because there is more to take into consideration. I hope that makes sense. If not, I will show you that in a moment. But let's look at what most crypto traders do. And let's say here we're on a 15-minute time frame. Now, of course, to take a trade on a 15-minute time frame is completely fine if you're limited to just what you see here. But the truth is you're still really gambling if you're only looking at exactly this or using the 30-minute paired with it. Because if you look over to the left-hand side, if you were to take a long here as an instance, there's no support. There's no previous price action. So you're basically gambling that what is here is something real. And you are then reacting off the candle. Now you will note here, I have no colored candlesticks. It's all the same color. But let's use for this example what most people do first before delving into something a bit more plausible, which I use myself. And we will start off like this. Now, most people are reactionary to the current candles. So as an example here, bullish candle, people buy, bullish candle, people buy, bearish candle, people sell. You will eventually get a trade right, but more often than not, you can see when you react to the simple candle that's green, or in this case, gray, more often than not, it's not going to work. And we can use the current example as an example. Bearish candle, people would have sold, immediately engulfed straight away. You need to have a full scale of the bigger picture to be making concrete decisions within the market. Now, if we were to highlight what we see here on this chart so far, and then go back to a daily time frame and zoom out for the bigger picture, you then realize you are seeing a very insignificant aspect of the chart and a very small percentage of the overall bigger picture. Now, your goal as an investor is to put the odds in your favor as much as possible. So, whilst you can see a significant amount of price action on this daily time frame that stems all the way back to almost the very early phases of 2024, you still cannot see the entire picture here. And this is where top-down analysis comes into play. You must use that monthly time frame to understand key levels, because if you're in the unknown, what you see here when zoomed in, as an example, where is the key support first of all? Simple levels of support and resistance, it's over here. Now, if you're too zoomed in on a 15-minute time frame, you can't really see that support, nor would you know that support is in existence down to the ground if you're simply looking at these lower time frames. You would be trading off this basis, but this wouldn't be here because you can't see that all the way over here there is a key level of support. And the more you zoom in, the more you are actually increasing the likelihood of losing without understanding the bigger picture. So we need to immediately understand that this is the easiest way to fail in trading. And even on a 4-hour time frame, which can be acceptable in many circumstances, you really want a lot more in your trading. And you want a lot more on your charts to gauge the bigger picture. This is why top-down analysis is crucial. Now, if we start to go up to the daily time frame, whilst it's not bad at all, and again, remember the rule of thumb, you want to be able to look at this chart whilst those candles have as much clarity as possible or as visible as possible. When we shift to the weekly time frame, suddenly you can see a lot more, which is why I believe this is a beautiful fine line and the best midpoint possible to not just get short-term trades, but also understand the bigger picture. When we go a step further and bring this on to the monthly time frame, suddenly analysis becomes much easier, I think anyway. And that's because you now have the entire visible picture right there at your disposal. And what the beauty of these higher time frames is if I remove the colors once again and bring this back to my lovely eye setting, so it's adjusted to my eyes because colors hurt me, to be honest with you. Now, when you look here, you are able to see the entire boundary of the trading range, essentially your playground of where you're trading within. And that means whilst you don't really need to worry about these levels, you can use trend lines, which I'll be showing you later, that can assist you with navigating these levels. And you're going to start to see how trend lines that stem back from 2020 to 2018, 2017 come into play at a later date. And the general rule of thumb for the monthly time frame is this is where you can identify key turning points in the market. This is where you can look to make spot investments combined with the weekly and combined with a daily, and then going down lower from there. Furthermore, this is a great way to even begin projecting where the year can go, where the month can go. And it's beautiful because if you can gauge what this monthly candle is likely going to do and where this will trade within, you can then stem down to the weekly time frame. As an example, let's say now from this high, this is something we actually mapped out with members, but let's just say I was looking for this particular region. By understanding that the monthly had a great chance of coming into around 124, 125 to start the month, and possibly by the end of the month, get down to here, into this region of, let's say, $107,000 to $106,000. By understanding this is the current monthly trading range of key resistance and key support, you now have a concrete formula from the offset of where to look for number one, large swing trades that can take place within the span of the month, but also use this to take intraday trades between the key levels. And if you can map this out, your life will become significantly easier. Now, as an example, if we were to add another level on this monthly time frame alone, just at this region, which was one of the last real levels of resistance that were broken, which has now come back down as support. If we then go to the weekly time frame, and you can see here, if I make this gray, that this was the kind of midpoint level that was rejected, but this level up above is not yet fulfilled. This becomes an easy way to understand that if this region is not yet triggered, the pullback that occurs to the next key level is an easy way to look for trades up to this region. Furthermore, by having a weekly chart oversight, this is how you avoid manipulation. The higher the time frame you use, the less likely you are to be on the wrong side of the market. Because what you see here is a liquidation of the high on a weekly time frame. But when you start to stem down to the lower time frames, it doesn't look like that. It looks quite the opposite. And this is where most traders go wrong, because this took place in the space of a single week. And if you're watching this on a daily time frame, a big bullish candle. If we change the colors once again to green, you will see that this would have given quite the opposite effect. But this is exactly how manipulation occurs in the market. The daily closes bullish and ever so slightly above that level. This took place on a Wednesday. So what most people were not able to comprehend in these moments, especially the lower down the time frames you go, when you're watching that level get broken or this level get broken and you see a bullish candle break above, most traders' immediate impulsive reaction is to buy. And whilst the market may give you a little bit of juice to the upside, it's likely going to counteract, specifically when a key high or low is liquidated. If you go to the 30-minute or the 15-minute or even the 5-minute, it looks like price is on a very aggressive bullish rally. But if you were to actually watch the moves develop on a weekly time frame, you would be able to capture this movement without being caught on the wrong side of the market. And the reason so many traders get caught out, very similar to over here, is because they're not watching on the higher time frames. And one of the next rules of thumb, I would say from the offset, is if you actually watch the lot of these moves develop, not on a 15-minute time frame, but on a daily, weekly, or monthly time frame, there is a significantly higher probability you're going to be able to capture these movements, because it's impulsive to us and almost programmed within us that, as an example, as this move is coming through, we must watch this on those lower time frames to try and get confirmation. But the truth is, if you were to map this out in advance and understand this is a high probability level of a liquidation occurring and watch it take place on a higher time frame, such as the daily, in this case weekly or monthly, it also filters the emotions out of the process. Because more often than not, looking at moves on a weekly or monthly time frame enable you to see quite clearly that the moves are not as big as they seem. And this is the next rule of thumb I'll be breaking down with higher time frames. The higher the time frame, the more you can see the bigger picture and the more you can understand that the moves people tell you will never come through again or are very unrealistic are actually incredibly realistic. And this is how most traders are not able to see the larger moves that take place within the market. Now, if we were to remove everything once again and redraw some key levels, just to show you as an initial understanding of where the market can go, if we were to create just some key levels of support and resistance on the chart, not perfected, nothing crazy, but just key levels of support and resistance, all drawn on the charts from major swing points on a monthly time frame. And we can do this for eternity, but just to give you an example, just keep duplicating until you get as many key levels as physically possible. Let's drag this one down to there and drag this one down to around, I would say there, where there's a lot of rejections before the breakout higher. And of course, we can keep this going forever, but let's just place one here as well. Now, when you're watching this in that moment, as an example here, by simply understanding at this point in time, that was the key level of support, the likelihood is price will go there again. And it's actually not as drastic as it seems. Simultaneously, price would reverse back down to there again. Now, applying this in the similar concept down below, at this point in time, when we were up here, if you understand using a weekly or monthly time frame, that those are the key levels of congestion where price has reacted previously, you know there's a very high probability that at some point the next pullback will come back down to the previously broken level of support and resistance. And this is applicable even here. When we broke up above at this point in time using one singular level, we can clearly see exactly between this range where price would likely have gone upon breaking higher. Because the moment this high is broken, if you understand where the next pullback level is, you're able to view this with enough clarity to understand it's not as crazy as it seems. But most traders, they simply look at numbers. So if you say to someone at $74,000, we could go down to $50,000, they would tell you you're crazy, but you're not, because the numbers make it seem and are almost a distraction mechanism from the reality of what the markets can do. But we can see a key region over here, one of the last levels of resistance before breaking out, came in to get rejected, and then we bolstered higher. The same is almost applicable. It wasn't perfect on this chart, but over here as well. And the moment that bullish candle comes through and we achieve that price point, although it wasn't perfect in this instance, we can see we basically came down to the very same level again before progressing higher. Now we can apply the exact same process to the present day. And when you have the monthly time frame situated on your charts, we can place two key regions from the offset that we know are very likely going to be revisited in the next market pullback. And you can see that from the offset is around $103 to $100,000. By simply drawing this one level on a monthly time frame, you are now able to understand that if this is to begin pulling back, the first key region you must now watch is around $100,000, because price has broken this region here, changing the color of this very, very quickly to black. It's pulled up above, but we have not yet rejected. So whilst you would be trading even short term within this range by knowing the key levels, and we can also add another one up here and another one down here. From the offset, these are the most key regions on Bitcoin right now, including the midpoint we're currently at as we speak. So if I was to change the color of these to differentiate, you would be able to identify some of the key regions, whilst also looking at more of the local miniature regions in between. So as a next key level, we can also do this in a simple color-coded system of breaking this down in individual colors, with the pastel color I've chosen here being where the key levels of support and resistance now are, with the recent high at $124,500 being the most recent key monthly level. And by mapping this out, you now know if this level is invalidated, there is a massive probability that this region is next. Furthermore, if you remove these levels, you can also understand where the key overall movements will take place. And you can see this is very easily understood because we have the least amount of candles on our chart possibly. Yet if we have more candles on our chart, such as a 2-hour time frame, it's not as easy to determine these levels, and there's a lot of crunching up and a lot of noise you have to go through to determine this. Whereas by simplifying the process for ourselves and looking at exactly where the market has turned on a higher time frame basis, life becomes significantly easier. Now, why I say this is because if we also go back and bring these levels back to where they are, you now have a clear reference point for your trading. This can give you an edge in holding trades. Let's say you're short and the market breaks this level. You now have a stronger indication and another confluence and confirmation that the likelihood is this will reach down to the next key level, which has the highest probability at present of holding as support. If this breaks, well, then you already know there's a higher probability of the second level. And by understanding this, life becomes much easier, because this also stops you from getting lost once you delve into the lower time frames. So by drawing some very simple levels here, let's say now you are looking to take trades on a lower time frame. This can allow you to not get distracted by what you see and suddenly understand that by taking a trade at this very level, which if we go to on a 30-minute time frame, you realize you're not trading near the key regions anymore. So there is a heightened risk that where you are trading has a higher probability of not maintaining. Furthermore, it allows you to keep in the back of your mind that, let's say here, you take a long trade. And price, you're looking for a big move back to the highs, and you get a temporary move, but price begins to stall. Let's say it comes back to the previous level. Now, bearing in mind, this can be continued for eternity, because then you can start to map out key regions of support and resistance on an intraday basis. But the key is to understand that's completely fine. And that's actually what you should be doing if taking trades. But you must now realize that the overall journey at present is for price from this region to most likely begin revisiting this region, if not progressing down to this region. And by breaking this down in a color-coded system, you're able to take the correct intraday trades in line with the overall market direction, because you now understand if these were all removed from the charts, it suddenly becomes a lot more complex. And a few simple zones can bring a whole bunch of clarity back to your trading, allowing you at that point to then refine in the lower time frame system and identify key regions of support and resistance within the overall key regions on a monthly basis, as an example from here. So you now know by drawing this without any other legwork, if this breaks, we're likely going down to $112,000, if not 110. Life is simplified like that immediately. And this is one of my favorite ways to understand and prepare for moves that most crypto traders, unfortunately, as simple as it sounds, it's really that easy. It really is that easy. Now we're going to go ahead and remove the colors because this is where things are going to begin to get a lot more exciting and a lot more simplistic. So you may be looking at this now and going, well, this is common sense. We should all know this. But the truth is most people do not know this and most people do not use this because they're far too engrossed in lower time frame trading. But if you're able to understand the key turning points of the market and where it has turned from historically, life becomes so much easier. And this can be amplified moving into a 2-month time frame, moving into a 3-month time frame, moving into a 6-month time frame, and moving into a 12-month time frame, where you can essentially gauge the entirety of what's taking place immediately. Now, the key to understand with this is the rabbit hole this leads you down in. As an example, on a 12-month time frame, there is no better way to understand what can take place for the duration of that year than by looking at this chart, because this is a yearly chart. And another rule of thumb is you use each time frame, which again may seem stupid, but each time frame is basically used to gauge what can happen in the duration of that year, in the instance of a 12-month time frame. So with 4 months left till closure, over the course of the next 4 months to next 12-month candle, what is the most logical levels of support we can find, which will suddenly assist us in identifying where the next bear market could be heading. And this means going over here again and dragging this down to there, which we have not yet struck, which is situated at $69,000. Furthermore, in terms of the most key prominent level, it's around $47,000. So just by having these on your charts and even adding one more for the sake of simplicity, very similar to here. 2017, this was the high. 2020, 2021 cycle, where did we end back up? In 2022 during the FTX crash, right back to this level. Now, if you look at recent times in the exact same way, the $46,000 level, let's say 47, but I will say 46, we have broken above. We have not yet come back down to reject this level, which means in the next bear market, the first level you immediately start looking at is $45,000. Now, because this factors in the entirety of an entire year, this can enable you to see a kind of timeline on how this may also take place. And in this particular example, this means in the next 4 months to next year, there is a possibility that we can achieve $45,000, $46,000. And that will depend on how this closes. Now, if you look at the lower end of where we could go in 4 months, you want to look at more of a realistic approach down to $69,000 as the lower end at the moment. And that means if this 4-month candle, or in 4 months' time, this 12-month candle does not exceed much higher, there is a probability that the following year will begin to head back down. And this is where you want to start looking moving into next year. And if I now remove all of these very quickly, and you disregard these key levels, having these there allows you to begin dropping down to a 6-month and understanding the concrete confirmations of these levels. And as we can see, with a bit of tweaking now, that's the key support. That is a perfect level of resistance that has not yet been rejected since breaking up higher. So we already have this now in our scopes. Now, this is beneficial in numerous ways. Number one, understanding this is an unfulfilled void in the market immediately enables you to stop feeling emotions of greed when the market exceeds higher, because you know at some point in the future, the market will likely reverse back down to this particular level, which will become your first assessment point for where the market could go from that point. You know, if this breaks, we are heading down to $17,000. May seem insane, but of course, if we get down to there at that point, it's more likely that if that broke, we would get down to there. So it's not necessarily anything to worry about, but it's about understanding it enables you to have an open mind and see the market from a perspective that most people don't. Because if this level's not yet fulfilled and this level's not yet fulfilled, you suddenly realize that if you're holding this thing and you're in a profit up in this region, inevitably at some point, there's a high likelihood the market will trickle back down to this level. So you can then ask yourself an immediate question that whilst you may not know exactly when that's going to happen, you could be subject to a 45% from the all-time high to a 65% essentially drop and loss in your portfolio. And having these there immediately takes emotion out of the picture. We can continue this for eternity because in 4 months' time, this candle will close, which means if in 4 months' time there is a closure below the previous high, there is a higher likelihood that we will be achieving these levels because price will begin to find resistance. Now, as an example of this, what you can actually see in the grand scheme of things is congestion is already truly beginning and has been beginning over the course, by and large, this. Since 2024, we've actually been congested in this region. If you go to a daily time frame, you can see that and go, okay, a lot of decent movements occur in here. We've bounced up and down, blah, blah, blah. But actually, you can kind of see by going from a 6-month or 3-month and then zooming down to a 4-hour, you can actually see, or especially a daily time frame, that price has basically broken out into the upper end of a range, but may not sustain here much longer, or at the very least will come back down to revisit that level around the $108,000. It enables you to see what's taking place on a higher time frame, and of course realize that many of the moves that take place in this region are not as large as they see. As a matter of fact, you can see the real congestion is starting and has started from around this region here. And what we have now seen is a very large push to the upside. So by looking at this, 4 months, this closes. The 3-month time frame closes in 1 month and 13 days. You now need to assess what this could mean from the next time frame basis. Because whilst the 12-month shows us a possibility moving into next year that we could achieve these prices, it will be these timeframes, ironically lower down the system, that begin to give you the turning point of how you will get to these regions. So by knowing where these key levels are, we can begin to work our way around to try and decipher how and when we could potentially see the turning point for that. So at the moment, we know it's probably not going to happen this year. That would be crazy. You're never impossible, and you never want to say never in crypto. But by looking here, I would assume from the offset that this is something I would take into consideration between 70,000 to 46,000 next year, which means on a 6-month basis, we need to use a simple pattern of where the market could be going before that, which means we now have 4 months till this closes. This closes in 4 months. So how do we determine where this can go in the next 4 months? We go down to the 3-month time frame. We then go down to the 2-month time frame. And we can see what could be taking place here. Now, looking at the markets alone, without anything else added to the charts, can be very difficult to understand how a key level is obtainable. And what we're also going to do here is just add a few more of those key levels back to the market once again to gauge exactly where and how we can possibly get to these levels. Because it all starts first and foremost with the monthly time frame, ideally, and anything above, if there's clarity, is a bonus. Now, if you look at this BTC region, for many people, this would have been an unpredictable move. How could you have seen such a thing take place? Well, I'm going to show you one of the easiest things I did to actually gauge the first bounce and the second bounce, and it wouldn't have been visible unless you had the monthly time frame. And this singular trend line alone is how we are now going to prepare for the next bear market already, and also understand what could be happening for the remainder of this cycle. Now, the reason why I believe there's going to be a major turning point in the market is because whilst most people are blinded by the trends over here, they're forgetting that the trend started from here. And by dragging this out, in theory, how easy would it have been if I do remove everything very quickly, go and get the replay tool open and map this out from here, which is easy to look back in retrospect, but theoretically is the easiest way to have determined where this cycle would go at the very least is to draw this trend line out. Now, at this moment in time, going back to the kind of FTX crash fiasco and situation, you're not going to know if it's ever going to be met, and you don't know when it's going to be met. And this is why I always say timelines are irrelevant, because you don't need to know when something happens, more so where something will happen and where certain things can take place. What I also mean by this is if you have a timeline, it sets you up for disaster and quite frankly has no real relevance. You know, a lot of people say to me, but Torre, do you think this will happen by Q3, Q4, Q1997, 4-year cycle, 5th-year cycle, backflip somersault, etc.? Supercolor, fragilistic, expialidocious. And to that, I always say it does not matter how long it takes or when it will happen. What matters is prices. Price reacts to trend lines and prices. Now, whilst this is an easy example to show, if we were to just press the play button, maybe not because it might take some time, but I can fast forward this very quickly. Now, I'm going to stop this right here for a moment and break down the first example of why trend lines are so powerful. I know they're simple lines, but that's the beauty of this. And what makes people suffer and lose in trading is that they overlook the power of these simple tools. And showing many different examples, I'm going to show you how many trend lines come into play on a continuous basis that would, quite frankly, blow your mind at how easy this is. Now, looking at this particular region, from the offset, let's go back to this region. By having this one trend line drawn on your chart, knowing that overall in a bullish cycle, this is without the additional tools of Fibonacci's, there is a high probability that the next cycle will drive to this trend line. This would have allowed you, in this area of huge indecision, to see a possibility and acquire that extra dash of conviction to keep holding because this trend line here is not yet fulfilled. Now, what you can also see is there's another trend line here. You would never have seen this. And whilst this is a very large candle, having this here can keep you composed and emotionless as this stuff begins to happen. Now, of course, this was not truly achievable back in the day, but because crypto's been around for enough time, we have enough historical price action to understand the key boundaries. So whilst this is taking place, before I continue, I'm going to draw two trend lines here and show you how they work to absolute beauty many, many times over. Now we're going to go down here and draw this one out. Because whilst this is taking place to the upside, as you guys have probably seen from all my videos, I continuously remain focused on the downside simultaneously. Because this going on here is a distraction from what can happen later down the line. Now, as we assess this, the key to understanding the beauty of this also is when people say, how long is it going to take? As an example, it doesn't matter. And why it doesn't matter is because these sort of trend lines go higher over time. So if price had gone from here to there, we probably would have topped around 92. But because this has taken such a long time since 2022 and almost 3 years in total now, from that point of where the crash happened, or let's say the first top, if we had topped here in 23, we probably would have been looking around the 100K level. But because this has taken longer, it begins to give us an extra 10, 20K of potential upside move. And that is simultaneously the beauty of this trend line here. Because we have now progressed so far away from the outer boundaries of this trend line, by using the monthly time frame alone with two simple trend lines, we immediately have a key area we can begin to track for where the market can go. Now, of course, markets are manipulated. You will never see really a pinpoint strike of a trend line. That's where people go wrong. And anyone that tells you, as an example, this is how you trade trend lines. 1, 2, third bounce buy. They don't know what the fuck they're talking about because that's what the old retail mechanism is. That maybe used to work in the early 2000s, but that's what most people look for. And if it's too easy In that respect, there's going to be manipulation that occurs. There will be occasions that a trend line does actually bounce perfectly 3, 4, 5 times. Very rarely. And what often happens instead is quite the opposite. The market will often wick through in one go quite aggressively and close back above on a higher time frame basis. Or it will break, push down again, and then come back up above, reject and go. It is very rarely a textbook perfect example. Very, very rarely. What that means is, with that information and understanding now, is this level is not going to be a pinpoint strike. But what it also means is, in line with the current candle on a monthly time frame, you can start to anticipate a particular level that would obviously be completely random if you didn't have anything on your charts. You would have no concrete evidence or even a simple guideline or reference point for where to potentially take some profits or where to look at a key turning point if none of this was on the chart on a daily time frame, as an example. Over here, price just looks incredibly bullish, but how would you determine a turning point? Well, you need to go back to the monthly for that, and possibly even a higher time frame. You can see on the 2 month, there can be slight alterations where necessary, but this is the beauty of those higher time frames. This means life becomes easier because you now know here in the space, they're a bit different as you can see, but you can, and this is why I prefer the monthly, by the way, because these are not always as accurate as they can be. You can see here, it's a bit different. On the 3 month, it's a bit different again. You've got to drag it down. The monthly is the perfect fine line, I find, for this stuff. And what this means is to create a key level of resistance, this outer trend line here gives you the entire boundaries of where we're trading, which means you already know, by the way, that the first real area to look at in the next bear market, once the market's done playing around with these regions, is to look down here. So this will also enable you to understand, if you were to take some profits off, if you had bought anywhere here, this would be a great area to do so. And simultaneously understand the first area you're going to start looking at buying from the offset is whenever the price reaches this level, will be the area it most likely respects. So as an example, if it was to strike this level in a single month, which obviously wouldn't be very likely, it would be around $26,000. But the longer you leave that there, and another rule of thumb, keep stretching that bad boy out, because the longer it takes, the higher it goes. Of course, the same applies to downside trend lines. So that means if this came through in 2028, you'd probably be looking around 40K, give or take an extra 30K or 10K to 20K push, which can happen. That would be your immediate region to watch. So let's continue on this example here and understand that as this is happening live in the moment, your goal is to continuously adapt. So let's say this monthly candle closes and doesn't achieve it. Well, that means moving into the next month, you've gone from $114,400 to $115,400. And this constantly adapts day by day. Now, if we look at what's going on here in this range, as this is all going on, because that trend line's there, that pullback down doesn't deter you, because you understand that even if this pulled down to here, which is why I'm often optimistic, because let's say the market dropped down to here at this point. Well, hello, this is not yet struck. And this has now moved up to here, 117, 118,000. So let's say price crashed down to here and deviated away from this trend line and came down to here and then suddenly took until November, December to come through. Having this here tells you from the offset that this is where you need to be looking when the market goes against it, because that is an outstanding area that will very likely be struck at some point in the near future. But bringing this back to here right now, using this as the first current example, let's play this out a little bit more and see what obviously happened in this region. Because as we begin to break higher, we're going to stop for a moment and let this begin to push. Now that we're here, we've gone from originally 114.4 or so. I'm not going to make this perfect, but let's just zoom in a bit and align it for the current month. It's around 120,000 now. Now, what I tend to do in these regions is obviously with a monthly time frame, wicks can be quite large. And if you look at the size of these wicks, they can vary, but generally you're looking at a rather large distance to the upside of around $5,000 to $10,000 movements on these wicks. So you want to always allow a little bit of leeway of around 5K to 10K. So let's say at this point in time, you're at $120,000. I would make that $130,000 to understand that is the highest probability area of where a major turning point will occur. Now, of course, as we continue to play, Lord behold, the first region we strike on a monthly time frame is here in the current day. Now, I was actually looking to short this, and unbelievably, I missed it because it came through at 4 in the morning in Dubai. But now we can start to work off the current boundaries and start to build a bigger picture of how crucial this region is. Now, what we also need to understand is this level at the moment, let's say for the yearly basis and go to a yearly time frame. How does this look on a yearly time frame? Well, what do we know here now with this information? Over the basis of the next 12 months, first of all, we need to really see how this 12 months is going to close in 4 months' time. Does it break above or does it hold? Because if it holds, there then becomes a probability that next year could drive up one more time and then begin to make its way down. This already gives you the entirety of what can happen in 2026. Factoring in what may be a bigger push between the boundary of the trend lines, because if this done the same through the upside, you would want to apply a 10, 20,000 move to the downside. I don't think we would obviously go that low. I'm not saying that, but you get my point. This is how you make trading easier. Now we're going to go back to this example and start to look at this now and go, right, is there anything else present that we could potentially use to gauge an idea? And as I start to draw these trend lines, this is just to create boundaries, by the way. I haven't even shown you what the depths of this goes to. But using this now, okay, are we near a top? Maybe, but it may not be over yet. In fact, if we are to break this trend line, knowing we're pretty limited at this point, and you know when people say price discovery, that's a bullshit terminology. Because after all of this movement, we stopped here. There is no price discovery. The market is driving to predetermined levels. If it had driven up here, that would have been the predetermined level. This is how you combat price discovery, which for me is terminology people use when they have no idea where it's going to the upside. And this is what causes a lot of emotions. If this simple trend line was not used, and you're just watching this bolster upwards, let's bring back a dash of color again. So go and view this in the way that most people do and remove everything. Well, of course it's price discovery because you don't know where the hell it's going. You have no idea. So you say things like price discovery to basically back up the fact you don't know where it could go. And you basically buy off that basis that it could go up forever. If you do not create boundaries within this chart and understand the playground, you will not succeed. Quite simply. So let's go and bring back what we had and bring this here, and let's bring that color back again very quickly. Now I'm going to start showing you some interesting stuff here. Now the key to understand with a monthly time frame is the further boundaries you can go from the key highs and lows, the better off you will be. So to first of all continue with the upside bias, do we have anything else here? Yes, we do. Now this has been struck at this particular point. So we need to make that zone from around $122,000, which is actually the level we have here for the YouTube videos that I give you guys and I mapped out. You see this? This was covered in the YouTube video recently. Look at that rejection. Bang. There's a trend line there. It's that same trend line. Now going over here, we've got 122, let's say. And let's make that $132,000. Now, theoretically, in this instance, it could be around, it was more refined. So we could theoretically make this smaller. But this is enough of a boundary here that I'm just going to make this around 125. Because that can be enough for now. Now, do you already see something here? The trend line enables you to see we may not be done yet. And in fact, we may have another leg to continue. So should we create a vertical line? Let's say we're using a reference point up to the end of the year. I would say in the same application, we can begin preparing for where the next upside could go by the end of the year. And this would give us plausibly a clear window up to even $160,000, specifically if not met now. But you can't be foolish. What you need to do is, whilst you're still dangerously close to this level, is have a trend line there and draw it like that. We can zoom in a bit. It's not going to be perfect, but that's around 140K. That can be the current tracking reference. And this is what you do to now understand that if the market was to suddenly rip higher, you would immediately be looking towards this region. Now, of course, this is not perfected. You can see I've cut through a little bit and there's all sorts of stuff going on. But okay, we can go up and draw a theoretical wick, call it 139. You're going to leave leeway anyway, so you now understand immediately $140,000 is the next upside target. If we break this level, we are immediately, over the course of this month to next month, we would be looking there. Where would we be looking for the next pullback? You guessed it, back to that trend line. If we were to continue upwards, you would be looking there. And if we were to then come back down and see this level eventually come through, if that marks the market top, the likelihood is it would break, reject, and eventually trickle its way down to there. Now, here's where things get even better, because we can use these trend lines to our advantage to make life so simple. And hopefully at this point, you are now beginning to see why it's very simple. Because this would be an emotional move. If people do not have this on their chart, they would see $140,000 as a sign that we're going to $250,000 to $1 million. But no, this would allow you to emotionally understand where the next leg up could go. But would we just drop straight down? No, we wouldn't. So as a trader and a crypto investor, of course, most people lose everything on the downside moves. It's very easy to be a genius when the market looks like this. But how do you determine the worst case scenario and prepare for what can happen before those upside moves come through? Well, of course, you need to start drawing some support trend lines from the lowest point possible and working your way up the system. That's the lowest worst case point. And simultaneously, if we were to be here at the end of the year, that would be the low to watch for, $50,000. Now, applying what I showed you in the beginning of this video, you can combine the key levels with the trend lines wherever possible. As an example, dragging this from here to there means over the course of, let's say, next month to the following month, around October to September, you can see two strike points here. If I was to make a zone, you can drag it down to around that touch point, from the starting point up there to the low point there. Look at where that is. That immediately tells you that if something drastic is to happen, that's exactly where you want to be looking. Straight back down to the key level of support. And by watching this on a monthly time frame, you would suddenly realize, if you're zoomed in on a 1 hour time frame and you suddenly see a candle, if you stretch that out from there to there, and you're zoomed in like this, and the market begins to absolutely die to the ground, well, yeah, you're going to shart your pants. I'm trying to find the right tool for this. There is a ghost feed somewhere, I believe. There we go. So let's just say we start dragging this down all the way to this level. It doesn't do it very accurately, but let's just say down to here is where it would go. Let me just stop this and drag this all out and just pretend it's happening in one simple go. Well, of course, when you're zoomed in on a 1 hour time frame like this, it seems like the market is dying and dying and dying, and you wouldn't even be able to comprehend the move that you're seeing. But on a monthly time frame, if I was to zoom out and show you this and then go, well, what if in the worst case example, this happened and then this happened? You begin to see opportunity. And you are now able to see the market with the keyword we mentioned in the beginning, a bird's eye view. This is not only how you are able to predict and understand the worst case example, but also understand where market moves perceived as impossible are actually incredibly possible. And it also enables you, the more you draw, to understand the overall trends we're trading in between. Now, this is not going to be a perfect drawing, but of course, from the outer boundaries, I should probably use a rotated. In fact, I'm going to use a highlighter tool, and please excuse me for what is about to take place here, but this may be the easiest way to do this. By dragging this down from here to there and into this range, and then changing the color, but so slightly. Actually, no, let's just make this nice and girthy. Let's make this nice and girthy from here and just highlight this entire range. This will basically enable us, if I quickly doodle through and increase the girth, hopefully that will make this a bit more visible, like that. There we go, we can do this. So this is the current outer range we're trading in between. But internally, by drawing these key monthly trend lines, you are able to see there are internal trends within the overall trend. If we increase the girth of these outer boundaries, you can now see that in between this, there are other miniature trends that can lead us to these boundaries, if not beyond, such as this and this, which is the current area to really watch for. And the same is applicable here. If we start to drag this down and understand that in the worst case scenario, this is a short-term rejection from this region, you of course need to look at the next trend lines down in the sequence, which means over the course of the next 2 months, your eyes must be fixated down here. Now, if I do this and duplicate this again and make this gray and drag it from around there, this is basically exactly the previous level I showed you in the very beginning, which is this region, the key level. Now, obviously, the market is there. Where we drew it was from around there, but you can see it's basically in line with that. So it gives you a window of where the worst case example can happen. Why is this beneficial? Because you can see internally, there is a miniature uptrend taking place here. And the market may very well expand out to this one. I know this is an absolute art attack chaos, but just to give you an idea of how the market's moving internally with trends, it helps visualize the process further. Simultaneously, we can go a step further and drag this out from there. How did I predict that top that time? Well, guess what? I used that. Very simple. Because the overall trend was taking place from here. Therefore, in theory, this is the same channel that's come into play. And at that moment in time, what was a very random level to most people during inauguration was a visible top to me. And this is how I managed to predict that top. Now, unfortunately, as you guys probably know, we didn't get into my key targets around 70 to 60. But from that high to that low, we got pretty damn close. And that was predictable because of that channel. The market was following a simple channel. There we go. Very simple stuff. Now, within this channel, we need to be looking at possibly coming down to there, which could bring this through to the next level higher and complete the sequence, which would also then become, possibly in this window, the manipulation through the trend line to the upside, which would be up here, and very likely an area where the final squeeze of the cycle could occur. Now, this is the example I showed from here, where most people, and again, please be wary of anyone that tells you the market is this simple, because it absolutely isn't. What often happens, and the same is applicable to the upside, is the market will bounce, and often have some form of fake move through the major trend line before continuing the actual trend. Now, this is the key trend line. So that movement there could very well be the case that ends up doing something like that later down the line. This would then bring into play the 12-month time frame, bringing us back down to fulfill the trend line, leading into a window of possibly 28, 30K, if that was to be the case. I hope this is all making sense. Now, I'm going to remove some of this, and we're going to go back now to removing the colors. That was just to give you a little idea. You can use a rotated rectangle and stuff as well, just to differentiate like this. But I wouldn't actually recommend drawing this all on your charts. It would be something to maybe draw, as an example, just to give you a rough idea of the trend, but it's not actually a necessity, because once you train your eyes to see this, life becomes remarkably easier. Now, what we need to do here is start to determine how we could possibly start getting into the wider trend line, such as these two here. So I'll quickly bring back another zone, because we now know some of the most key areas are likely situated between this region at this present point in time. So we need to try and determine how these monthly trend lines could be obtained. What we also need to understand is if there are any other signs of where the market could go next. Now, if I quickly bring this into play, this was the last outer boundary we can see from here. Now, if you look at this level and look at what's taken place here, this is around $96,000. The market has not yet come back to revisit this level. So whilst these levels are key, the immediate level is right here over the course of the next 2 months, a very key region to watch for. And this is exactly where I showed you at the beginning of the video. So we can now remove this for the meantime, or even leave that there actually. But you can now see that something took place here. We broke through, rejected, broke down, rejected. We've now broken up above with no rejection. That immediately sets this region into focus as the next major key level of support, where you can see the market could very easily come down to this level before continuing the trend once again to the next levels, potentially up above. That now creates your first basis point. Now, looking back in retrospect, I should have seen this more vividly, and I actually saw $74,000 as a short-term bottom, which I thought was going to bounce and lead to one more drive. Completely put my hands up and say I missed the bottom on that one. But luckily, on the move down, a lot of the altcoins that were here anyway came back to those levels, which is why I bought recently. But have a look at this. If we continue the trend line journey, here's where things get very juicy. We're going to go back in time once again and remove everything and go back to the key boundaries from just this level over here. And we're going to remove this. We're going to go back to here. So we know inevitably at this point in time, the target overall remains in this region. What we also know is in the short term, this is the first level to watch for. It works like a ray, almost like several floors to a house. To achieve this level, this must be broken. Now we're going to let this play out, because how we also know this is by drawing the outer boundaries. We know where the breach of this trend line will go because of the green trend line over here. So this immediately sets any rapid movement to the upside towards around $101,000 at this moment in time. That will break this trend line. Furthermore, there is a new trend line just here that now needs to be invalidated as well, because this reversal created the next trend line in the sequence. So we're going to press play, and you're going to start to see some real magic happening, where we're not using anything besides trend lines to gauge where large movements will go with the monthly time frame. We press play, we allow this to begin moving, and Lord behold, the first region comes through. We hold ever so slightly and we push higher. Of course, this is where mass FOMO begins. This is leading into Trump's inauguration. We press play, we continue, this plays out, we basically come into that level. Now again, this is not perfected. If I just quickly perfect that wick to wick, we basically perfectly struck that, or maybe just ever so slightly fell short. But basically, that's close enough to understand what I'm getting to. Now look here, where the magic begins to happen. This trend line is holding, but does it actually hold? Where do we go next? We drive in to the next trend line. We hold this temporarily, we break through. So the next trend line in the sequence comes into play. We then continue higher. Now even here, this is not perfected. There we go. I'm only doing this roughly to give you an example. So you now know with this fulfilled and this still outstanding as the first key level, whatever's taking place here, which has also basically come back to the key levels we showed in the very beginning of this video. Again, it basically just fell short, but you get what I'm saying. It's basic enough to understand. We now need to breach this level, and possibly we're at the point of finding support to achieve the final level. So when we allow this to play through, we can see that once this level is broken, we've now continued, Lord behold, eventually, to the next level, to the upside, with a pinpoint strike on both monthlies. Now, where do we look here, ladies and gentlemen? You can leave these here because they will come back in the future, I guarantee you. But now we need to set our current focus right here on the lower end of where the market can go. And over the course of around the next month or so into October, leaving a kind of 2-month leeway, we'll drag that out to there. And all of a sudden you can see not only is this a key level of resistance that has not yet been rejected as support, but there is a new trend line that's been broken that has not yet come into play. And as we begin to adapt the overall bigger picture, this is what allows us to see the possibility of where we could go if this holds as support and continues further upwards. We can start to look to possibly $140,000, $160,000. Now, what we also want to do here, we can leave that there as well, is start to play around a bit more. Is there anything else we can see here that may be providing a sign of what could be happening? Well, what you will also notice is new trend lines have emerged in this mixture. And more importantly, using the outer boundaries, if we look at what's rejected here, again, this is why higher time frames are crucial. Because if you go to a weekly or daily time frame, yeah, it's technically broken, but not on a monthly time frame, which is what you use to understand major turning points in the market. So removing this, and looking at the current boundaries we have right now, is it not plausible to assume that we struck up and closed below, took out the high and closed below again? This would allow you to now begin to understand that whilst that is the key high, which will make pastel, the actual key level at this current region is right here and could very well now become the overall turning point for the market that is going to begin to bring us back down below $100,000 temporarily. So when you hear people, and these are the moves that are perceived as black swans. This is why I say black swan because it's just funny, but it's not even a black swan in theory. You know, if you look at FTX, it wasn't really a black swan in any way, shape or form. Now, if you look here, I would know now that if the monthly closes like this, there is a very, very high probability that this could come through. Do you notice something about this level? Even if you draw the trend lines, whilst it's not perfect, and it could be an indication that it comes through later after we drive higher. But if this was to happen, everyone would scream black swan and most people would get liquidated. But you are able to make sensible trading decisions by understanding the boundaries that we are within. The same way that over here, the market done the same thing. Now in this moment, bullish candle, mass euphoria. All we really had to do was draw a trend line to understand the market would come back to break this invalidated level and revisit. This is no different to now understanding, like I've just been saying, that if we push up to here and push above, let's say at the end of the year, the first level to immediately look back at will be the trend line, which of course people will tell you we'll never see again. And even if that means a new high from there, it would likely hit that level first before proceeding further, if that was to happen, which I don't really think will at this point in time. And this is really the cheat code for me for making trading so fucking simple. It's unbelievable. You just need to know how to view the market with the correct lenses. And most people, unfortunately, have the incorrect lenses set up. But it does go much further than that. And there are many different ways to tweak this, which we show members, and trend lines are not just perfect indications. And what I'm going to show you now is just a simplified version of this on the opposing side. The more advanced stuff will, of course, always be for members only, but this is just a really clear way to revolutionize your trading without really revealing any so-called secrets that I actually use, because this is not a concrete formula. This gives you a guideline. This is how you create structure and a framework and understand essentially the boundaries you're going to for bull markets and bear markets respectively. But there is more that goes into this. You can't just use this independently. You do need more. You need to combine certain things. But as you can see, it doesn't take much else. You just need to know how to finish off the recipe, so to speak, and add a little bit of garnish to the mixture. Now we're going to go over here and draw, what was this trend line? This was the original trend line at the time. The market broke, and look what it done. It went straight back to it. It held it as resistance. It then broke above. So when this was looking like the top, or when it was looking like it was going to blow to the moon, the market actually just revisited an old trend line and then continued the journey up to there. If you take this a step further and go over to here, you would have seen that the market stalled at this trend line, which marked the top at the time, before then coming back into this trend line to break this trend line, to begin its journey up towards this trend line. As you can see, it is a rabbit hole of patterns that continuously come through. Now, there will be times, and a rule of thumb here is the steeper the trend line. And what I mean by that is there are limitations. Here, another perfect example, by the way. This trend line was not yet in existence at this point in time. So if you were to go back in time to this region here, we've mapped out the trend lines ready. This is how I started to capture the bottom in 2022. And I captured that bottom perfectly using this amongst the key formulas. So the high's been taken out. Very similar to what we're seeing now, as a matter of fact. This tells us already that this low is probably going to get targeted. Now, there is a key outer trend line here. But before we get there, we need to break this one. So if we press play, the market breaks. What does the market do upon breaking? It comes back to the trend line first. It rejects it. It does what it needs to do. And then, Lord behold, we come in to the next one. And then it took out the lows. And then the FTX crash comes through to mark the bottom. Now, although this took a bit of time, again, you can't mark a new trend line until the bottom is formed. But by leaving this here, you can apply the exact same process that took place here to this level over here on this trend line, which I've just cleaned up. So as this is now deviating lower, your eye should be up there, because that's exactly where it's going to go at the very least. And if we press play, that's exactly what happens. This now becomes the next region to watch, which is where, using the additional tools we teach in our app, you're able to understand the next plausible upside region. And as you can see in a moment, we eventually go up to achieve this level. Now, that was a perfect strike. If we start to zoom out, once you eventually break, again, this is where you sit back and wait, because the market's likely going to come through to this region. And if it maintains, your next leg higher is coming through. So even in this area, as we floated away, this is where many people would buy. And if they didn't buy there, they would have bought again there. But simply knowing that's there just gives you a bit of an edge in knowing that you probably haven't got the real bottom. And only once the market has struck this level, again, let's wait for the reaction upwards first, just to show you. We're here for 3 months. It spikes down several times. But when you're watching on a monthly time frame, weekly, broken. Daily, broken many times. You see how it's a mess. There's too much on the charts. But the monthly time frame did not break it once, and that is not a real break because there was no closure below. It came in and rejected and formed a collective bottom precisely at this region to then proceed in making the next leg higher. Now, there's many different ways to draw this. I mean, any key high really does come through at some point in the future. They're not all going to be perfect, but if you want another example, this one here would have been a great one to determine exactly where the market will come back down to. And this is what helps you stay rational in bull markets. So let's say here, and why I was very bearish at this point is because we hadn't yet hit at least this trend line. So I knew even if we were going to go higher and continue up from there, we would probably come in and hit this trend line at the very least and then proceed higher. So this allows you to stay rational here to take profits because you know this is not yet struck. Very, very simple stuff for you guys, I hope. Now let's go further. One final thing to show you how effective this can all be and how to transcend from monthlies into lower time frames to get a better understanding of where we can go next. Now, you want to draw the key outer boundaries, of course. This is probably nothing to worry about right now, unless, of course, we go into a bear market from the top. And this was just the most perfect cycle rejection ever, which very rarely it is, to be honest with you. It's very rarely that clean. So I would assume there's going to be another squeeze to end the year. But let's just say before we worry about this is really the next major trend line of focus and allows us to understand the worst case scenario of, let's say, 90 to, unless of course it happens this month in 13 days, which it can. It's not the first time it's happened, but let's just say the worst case is around 86.90 to the lows there. We now need to go to the weekly time frame and start to see what the feasibility of this is. Well, now that we're up here, I already know to be cautious because this is the next logical trend line in the sequence. How do we know this is even possible? Well, you need to go here and go to the weekly time frame. And you will now see that we're at the cusp of breaking this trend line, which means if you see this broken on a weekly time frame, and it's basically on the cusp of breaking right now on a daily time frame, that is really your confirmation that the next trend line in the ladder sequence is coming through. So you immediately now need to consider that if this week breaks this level, there is a very high probability that the next journey down will take you somewhere in this region. Now, using what I just showed you, which was around there, that could be an indication for this. But if you go back to the monthly time frame and go to this trend line, even if this closes like that, next month breaks this trend line, which is a weekly trend line. That's not really existent on a monthly, but you can draw it on a weekly. Again, no complexity whatsoever. The market has rallied upwards. The market does not move in straight lines. In fact, the market often moves in continuous waves. In this particular wave, the market has been moving in a bullish trend. The market then proceeds to move into a bearish trend. The market then proceeds to move into an upwards trend, which will make green again. This now tells us if we break this trend line, the next bearish leg could be down here towards $90,000, which could then proceed to lead us to the final leg up to there using the regions I've shown you, potentially all the way up into that territory of $160,000. But it may get very, very bad before it gets very, very good. And that would be precisely where you would want to look to understand that. And again, we're basically identifying key regions using singular lines to understand the full scope of absolutely everything. Without being a genius, without calling it something funky, I have made millions doing this. Of course, not independently. There has to be additional stuff, various other things, including just intuition that really goes into this. But this has made me millions without complexity, without stupidity, just allowing myself to have the patience and also understanding of how this market operates. It's a foolproof system. So, as an example, if I do a video, I say, guys, in the worst case, we could get down to here. People go, impossible. We're at $115,000. No way that's ever happening. Well, yes way that's happening. It's very possible. It's right there. Same happened here. Trend line was there. We pushed up. We went back to the trend line. Trend line here. We broke. We didn't reject. Guess where we went? To the trend line. Now, over here, I can go on forever, and this will also take some experimenting for you guys to figure this all out. But you can now see one of the original trend lines here, broken, didn't hit, went back up again. Broke through, came down, holding here. If we break, what do you think happens next? It's a continuous journey from trend line to trend line. Now, in this instance, this is a bit of a grey area, this one, but this may be too steep. It also takes a bit of critical thinking to go, okay, well, if it hits now rapidly, okay, that makes sense. But of course, something like this is very random. So you can't assume that it will automatically go to this one, because if it stretches too far out, it's more unlikely. But it doesn't mean you rule it out, because in the future, if it was to exceed all expectations, you could use these to your advantage. But even here, on a very, very miniature scale, look at this. We hit the high, we came back to the low. So if this breaks, and this breaks collectively, well, I don't see any other trend line on the chart. So all of a sudden, this could very well become a reality by simply zooming out and having that understanding. Again, it doesn't need to happen, but knowing this is there, this already tells us that if you zoom out, the next major downside move is going to be in symmetry with this particular trend line. And the beauty is with these ones, is these are very far out. So you can almost see how everything you're drawing here is an indication of how we get to the next one. As an example, the pattern rabbit hole I frequently discuss. If we draw this out from there to there, and then draw this one out to there, if this breaks, there's a higher probability. This is also how I predicted that crash from there as well, because we broke all these. So it was pretty simple to understand that once we had broken this, we're of course going to drop down to the next one in the sequence, which we bloody well did over here. We broke from there, we come into this one. Now, if you look at this, should this break, the probabilities increase of coming down to here. If this breaks, we're coming down to this one. But the key to understand is the bigger ones. The bigger ones are the key. So if this breaks, there's a much higher likelihood that inevitably we will head down to here. If this breaks, we head down to here. And this goes as far as it can possibly go. And generally, the bottoms will be in line with this, unless, of course, some form of Armageddon is initiated. It's beautiful because it not only tells you where we can go, but you can use additional trend lines to understand when it will likely get there. Now, the rest of this I will not disclose, as there is obviously more to this, but I do genuinely believe that if you apply this to your trading, it will open your eyes beyond belief. My number one goal is to always make trading as simplistic as possible, not just for myself, but for you guys and for the Innovation Markets members. And whilst I'm not revealing anything crazy here, I'm showing you how you can really elevate your trading game with simple lines. You can combine this with your own strategy, combine this with your own analysis, and I guarantee you it will, if you're able to use higher timeframes and you're good at analyzing the market and predicting where it can go, it will probably align with what you're already looking at. There will be moving average traders, ICT traders, all sorts of different traders, Ichimoku clouds, who the fuck knows? There will be people using all kinds of different things, and often we all come to the same conclusions. That's the beauty of technical analysis. But I do urge you to give it a try, because it will really expand your mind. It will allow you to see the market for what it truly is, and not fall into the traps that 99.9% of all losing traders, especially in crypto, fall into. This is your cheat code.